Well, welcome everyone. My name is Hyun-Sung Shin. I'm the economic advisor here at the BIS, and it's my great pleasure to moderate this panel taking stock of the latest thinking about CBDCs at central bank digital currencies. I think it's fair to say that central banks have made a great deal of progress in the last few years in their thinking about CBDCs, in particular how they would fit in the broader context of the monetary system, where there's a very important role for the private sector, but also where the central bank can provide this core of trust in the monetary system through CBDCs. And I think we'll have a very rich discussion here. And as you heard from Cecilia Skingsley in the previous session, the BIS Innovation Hub has been doing a great deal of work on the various aspects of CBDCs. Now, to discuss these issues, we have a really terrific panel. And let me just introduce the panel in this order. We have President Christine Lagarde from the ECB, Managing Director Ravi Menon from the Monetary Authority of Singapore, Governor Chang Yong-ri from the Bank of Korea, and Governor Francois Villers-Radogallo from the Banque de France, and who is, of course, also our chairman here on the BIS board. So, Christine, if I may turn to you first, and ask you to speak about the digital euro. The digital euro is a retail CBDC. It's been in this investigation phase since October 2021, and the Governing Council will decide later this year whether to move into the realization phase. And both from your speeches and from other colleagues at the ECB, it's quite clear that you're thinking of this as another option for retail payments rather than at the expense of others, but to preserve the role of the central bank, money in retail payments and offering an additional option. And there's also a very important role for monetary sovereignty. So could you give us the latest in your thinking on the digital euro?
Sure, with pleasure. So what we have been doing is, first of all, exploring for a couple of years, then really investigating and trying to sort of decipher what the options were. And if the Governing Council was to decide so in October, we would move into the beginning of the implementation, which is not a definite green light, but certainly one that would move us closer to operating completely with a digital euro. So, I try to think of three key reasons why we're doing that. And we are moving ahead, and we are trying to be as practical and as granular as we can. I think the first reason we are doing it is for integrity purposes. The second reason we're doing it is for resilience purposes. And the third reason is for integration. So if I start with my integrity point, what we have seen throughout the euro area and in Europe in general is a dwindling use of cash. And this has been certainly accelerated by COVID. It has been tempered a bit during the terrible invasion of Russia against Ukraine, because there was suddenly a little appetite for cash yet again. But the general trend is less use of cash and more use of digital payments. The numbers are very clear. We have seen a decline of 72% to 59% in terms of use of cash, and the digital payments have virtually tripled during that same period of time. So everything is going digital. People are clearly expressing a preference for it, and there is no reason why we, as a central bank, should not be exploring also the reason why digital cash can be of good use. And as my colleague and friend Francois calls it, he says it's cash plus, because it is digital. Now, it is intended to be safe, it is intended to be sovereign, and it is intended to be available to all, anywhere, anytime, and at the cheapest possible cost, possibly at no cost, for the most basic functions. So that's the sort of integrity of the system. to make sure that we have an alternative to cash and to make sure that there is actually an anchor to our monetary policy and to the sovereignty of our monetary action, which, if cash dwindles away, is then anchored into a digital payment. Now, the second aspect of it is the resilience. It's to make sure that we can safeguard European payment autonomy. Because when you look around and when you look at your wallet and you look at your telephone and see the applications that you use for payments or the cards that you use for payment, you very soon realize that those means of payments are not necessarily European. Mm-hmm. So we just have to be careful, as we have experienced recently with other instruments that are of critical use, such as energy. It's very unhealthy to rely on one single source of energy. It's very unhealthy to rely on one single source of payment. I don't need to go into the details of those who operate in that respect, but it's clearly our intention to make sure that we have resilience in that respect as well. Some people will call it sovereign autonomy. I prefer to call it resilience, because that's really what it is. And the final one is that of integration, because in Europe at the moment, there are countries that have their digital method of payment, if you will, but those are, strictly speaking, national instrument, and they can be used in Spain or they can be used in the Netherlands, for instance, because those are two countries that have it, but they're not pan-European. And they are not universal. So our point is universal, available to all. So it's also an inclusive instrument, because you don't necessarily have to have a bank account to use the digital euro, and it should be available anywhere, anytime. Voila.
It's, I guess, what we call the tangible marker of trust. That kind of sort of link, I think, is very much what you have in mind. I think this way of organizing it, integrity, resilience, and integration, I think that's a very good heading. Ravi, if I may turn to you now and zoom out and look at the monetary system as a whole, thinking about how CBDCs would fit in the broader context of the monetary system, what would be the other pieces that you think would be very important in really bringing the full potential of CBDCs in that future monetary system, and where would functions like programmability, composability fit into that kind of picture?
Yeah, thanks, Yun. I think that's a very useful starting point, what the future monetary system might look like. But just to step back, what does a current monetary system look like? It really composes of central bank money at the core of this system. It's a two-tier monetary system, and the foundation is central bank money, upon which is private money, which is essentially in the form of commercial bank deposits. So monetary base is your notes and coins, and the reserves held, central bank reserves to the banks, and upon which the whole edifice or architecture is built. So most of our money is in bank deposits. And I think that monetary system will still be the mainstay. It lacks two features, which I think a companion monetary system will provide. So you'll have both existing side by side, and that is the digital currency system. Because our money today, while even if it's transacted through digital means, digital payments, it doesn't have the core characteristics of digital tokens. And here it is features like programmability, composability, and the ability to settle instantaneously. So cash in physical form settles instantaneously, right? When you pay, the payment and settlement is in one transaction. But when you send it through a digital channel, settlement is not instantaneous. And this is where, as Christine said, what you need is digital cash to combine the benefits of digital and the benefits of cash. And that is what digital currencies do. So I think this second monetary system that will coexist alongside the first monetary system will have that feature. And I think it's important from the security and resilience point of view, that monetary system must mirror the structure of the traditional monetary system. Two-tier system with central bank money as the core of the system, the foundation, and commercial bank money, the bulk. So I think the components there will be CBDCs as providing the foundation, the counterpart to notes and coins and central bank reserves. And we know today that private money to public money ratio is like 10:1. Most of the money we hold is private. So I think in future, CBDCs will be that base. And I think the second major form of money will be tokenized deposits, where the deposits that we have with our banks today, we can choose to tokenize a part of it, meaning we express that deposit in digital form, where our ownership rights are embedded together in the form of a token, and it can be transacted on a blockchain or distributed ledger. And that opens up possibilities to do many things that today we can't do. So I think you have a layer of CBDCs, a layer of tokenized deposits, possibly, and this is something, there's a lot of debate about, whether a third layer will be non-bank stablecoins, provided they are fully secured and backed. And that is where the challenge is. We've not found a way to ensure that yet, although I think several jurisdictions are working very hard to put in place the regulatory structures to ensure full secure backing. If it's fully secured and backing, then I think it qualifies as money, the same way your first two layers do. But I think we should not rule it out, because non-bank stablecoins, non-bank issued stablecoins can add to the diversity of the system and make it richer. But we need to make sure that it has the qualities of money. So I think so CBDCs I don't think will become the major form of payment, just like today notes and coins are not the major form of payment. But it is the anchor, it gives you the trust in the system. So in future, CBDCs probably will not be the major form of payment, but it is the core of that digital currency payment system, with tokenized deposits probably playing the bigger role. So that's probably one way in which that future unfolds, because then it doesn't have the problem of disintermediating the banking system, because the bulk of the liabilities, monetary liabilities, are still held with the banking system in digital form, in digital currency form. Because if it ends up with the central bank, then central bank has to figure out who's going to do the credit intermediation process. So I think that is one way in which might evolve. Very quickly on design features, I think the singleness of money is key. The BIS has emphasized this many times, and I think we should keep that as a core of how we think about this. Today, a deposit in Standard Chartered Bank, $1 in Standard Chartered Bank is the same as $1 in HSBC, right? And it's the same as $1 I hold as issued by the central bank. That singleness of money must hold in digital currency form. And that's very important. And you can't have, and that's a problem with stable coins today, even the securely backed ones. The singleness of money is unstable. But I think we should try to solve it. Second is open participation. These must be on payment rails that are open. And third is interoperability. I think if you have more decentralization, it's all the more important why there must be interoperability. The whole point of using digital currencies is to use it on distributed ledgers with features like programmability, with features like atomic settlement, automated market making, which means it must be part of an infrastructure of either distributed ledgers or other kinds of infrastructure that allows for this. So it cannot be separate. So there has to be interoperability rules or protocols established up front so that there is this maximization of the benefits. So I think these would be a fourth design feature is security, absolutely. Because today's payment rails are built with a certain set of security protocols with respect to cyber, technology risk, and so on. Now the secondary monetary system that I'm speaking about, the new one where we built a new set of rails, and I think the BIS has spoken about a unified global platform or infrastructure, the security of the infrastructure is critical. Yep. And the design features there may well be different from our traditional RTGS and payments networks, because these are, expressed as tokens on distributed ledgers, which brings about its own set of risks, which we need to be mindful of. So I think those are the four design features I would place: the singleness of money, open participation, interoperability of infrastructure, and security.
Very good. Thank you, Ravi. I think that's that's a very good jumping off point to Chang-Yong. Perhaps we could discuss a couple of the issues that Ravi mentioned. One is the role of tokenized deposits, the role of intermediaries, and he also mentioned the singleness of money. Sometimes when we talk about CBDCs, one of the rationales is financial inclusion. But as we know, when a financial system already has a well-functioning fast payment system, some of the commentators might say, well, what is the additional value added of a CBDC? How could tokenized deposits really contribute to the richness of the monetary system, and what do you think will be the additional functionalities that could come from that?
I think we need tokenized deposit because the tokenization of assets is well on the way already. For example, in Korea, we have security token offerings already, and many non-structural assets such as music, properties, and even Korean beef are tokenized. For example, like a company called Bancow is selling tokens, ownership of this calf they have purchased, is breeding, and then with the sales revenue to be distributed to the token holders once the calf is grown up and sold. So there are many tokenization of assets going on. So in some sense, in order to make, with this given high demand of tokenized asset, it's natural to think about how we develop tokenization of the the money side. So we decide in our pilot, we actually have done a 2 years pilots previous time, and our conclusion is that Korea is who has a well-advanced fast payment system. Probably the benefit of having a retail CBDC is quite limited. One exception can be the programmability of the money that Ravi just mentioned, but our conclusion is that even that same benefit can be realized and achieved using only the wholesale CBDC. So what we decide is together with the BIS, we will set up the infrastructure where the tokenized deposit can be issued and exchanged with the wholesale CBDC. And that has many merits that Ravi mentioned. It will maintain the two-tier monetary system intact, and while allowing the flexibility of the bank to address the different demand from the clients by exploiting the programmability function of the tokenized deposit. So that's where we actually heading for. And another function that we are expecting is wholesale CBDC's role in the cross-border payment system. And we decide to join the BIS-led platform together with Singapore and Hong Kong, the mBridge and Dumba, and which already have proven significant benefit in cutting the cost of the international transactions and reduce the settlement risk in FX transactions. But on the other hand, we wonder whether the system can be resilient if the scale of the transaction is increased significantly. What we have in mind is some uncertainty about the liquidity provision function in the system, especially during the time of crisis. So if the global or regional safety net can provide a liquidity provision function to the existing system, it can help the system as well as alleviating the so-called stigma impact of traditional safety nets, such as IMF program, for example. What I have in mind is some kind of digital version of IMF SDR, which can be programmed in advance so that they can actually provide liquidity automatically when the crisis happens. If the recipient are eligible with a certain criteria, that can provide the liquidity as well as reducing the stigma impact that the traditional IMF program has. So all these kind of things, and actually many criteria that Ravi mentioned and President Lagarde mentioned will be trying to incorporate in our next pilot.
That's, I think that's a very good follow-on to the discussion that Ravi gave and some of the topics. And Francois, I think in the last two presentations, wholesale CBDCs really emerge as a very important element in the design And of course, you and the Banque de France has really made some very big strides in thinking about wholesale CBDCs, especially in the cross-border context. So tell us about your vision for the role of wholesale CBDCs and how they fit into the future monetary system.
Thank you. May I start perhaps with a general remark on retail versus wholesale CBDC, because there could be a temptation to oppose them. I think we need both. And I couldn't agree more with everything Christine has said on retail CBDC. But there is a difference, if I may, in the situation. Retail CBDC raises huge public interest from politicians, journalists, etc., but still has some practical question on use cases. And wholesale, it's probably the opposite. The use cases are obvious, as mentioned by Ravi and Changyong, but the public interest is very low, unfortunately. So on wholesale CBDC, let me give perhaps briefly some historical perspective and say where we are now or where we should be. The historical perspective is that we central banks in the 90s invested heavily to build the so-called RTGS, real-time gross settlement system, and to put central banks' money at the core of interbanks and financial transaction. And it was a progress, and we saw it in the great financial crisis. The role of central bank money was key. We shouldn't lose that. Even if we have stable coins, but as Ravi and other colleagues mentioned, stable coins are not very stable. So central bank money should remain at the core of financial infrastructures. So where are we at the Banque de France? We are part of a Eurosystem endeavor. We have, so to say, parallel tracks. We develop retail CBDC, as mentioned by Christine. But we are also making our own reflections on wholesale CBDC. We will probably decide by the end of this year about pilots in that field. So we have been running, as part of this European work, at the Banque de France, 12 experiments in the last 3 years. Several of them with the BIS Innovation Hub, by the way, Dunbar, Jura, etc. Let me only focus on the 3 newest ones, the 3 latest ones, because they are interesting. 2 of them are about cross-border and how to ensure the interoperability of various CBDCs. And here we develop innovative solutions, such as this is one solution we developed at the Banque de France last year, the so-called AMM, Automated Market Maker, and we strongly believe wholesale CBDC will be the key for the interoperability. The last one is about another purpose, which is also very important for CBDC, which is to have safe settlement for tokenized securities. And probably the 4 of us are ready to bet that securities in the future will be tokenized, without any doubt. So how can we assure a fully integrated and safe settlement system? Here we have an experiment with the European Investment Bank and one other central bank in the Eurosystem, the Central Bank of Luxembourg, and we strongly believe in this second purpose. Just to conclude with, to say that we published in November 21 a first report of our 9 first experiments. We will upgrade this report this year and try to draw the lessons of all the prototypes we are running.
So Francois, maybe I can just follow up with a second question to you, just on this note of central banks actually engaging in innovation. To what extent do you think it's important for central banks actually to get their hands dirty, actually engage in the projects, get down to the details, and have some experience of producing things on the ground? And how much could we actually delegate that? And how important is that practice? No, I think this is a very important question and a bit sensitive,
because some commercial banks are a bit afraid of everything we have been saying in this panel in the first half about developing our CBDCs. So first, clearly, yes, we should have our hands dirty in this issue. We cannot be only on the side of regulation private initiatives. We are part of innovation, without any doubt. That said, if you look for centuries, money has been a public-private partnership. And Ravi said it earlier, it's perhaps 10 to 1, 10 private, 1 public, but we need a strong central bank money base. It was the case in the past, it should be the case in the future. But it will be a partnership. If I come back to retail CBDCs, there was this famous issue of disintermediation and saying that we central banks would open private accounts for individual or for SMEs. No. If I take the example of Banque de France, we stopped our last private accounts 20 years ago. I don't want to reopen them. And KYC, etc., everything will be on the side of commercial banks, and CBDC will be distributed by commercial banks. There is also this fear that CBDC could take massive flows from bank deposits and create financial stability problem. No. Again, the answer is no. There will be holding limits, at least in our case. So, if I dared to quote the former Pope John Paul II, I would say to commercial bank today, do not be afraid. Be part of this public-private partnership. We will build CBDC together, and I'm sure about that. Perhaps to mention a last issue, if I may, Yoon. One delicate question we will have will be the access to central bank money in this new form. At present, the border is quite clear. Banks have access to central bank money, non-banks do not. So there are sometimes reflections or questions, should we change the border? My answer at this stage would be cautious. I would say it's not because we will change the form of central bank money that we should change the border, or if we change the border, then we will have to regulate non-banks and to supervise them. We are not yet there.
I think that's a very important message, Francois. And Christine, if I could turn to you for another topic that has really garnered a lot of attention, and that is the issue of privacy and whether CBDCs could be the data that's going to be accumulated in the use of CBDCs, could be misused. And I think privacy has emerged as one of the issues that has been really very much discussed in the context of retail CBDCs in particular. What would be, do you think, the design features that could really address those concerns? And where do you see the appropriate trade-off between preserving privacy and know your customer and anti-money laundering type of safeguards?
Yeah, that's a really good question, and you are right that the public is particularly concerned about privacy. All the surveys that we've conducted, the client focus group, the reaching out exercises that we've conducted have all said the same thing. People are concerned about their privacy, and there is that, anxiety of a big brother central bank having access to data. And I think that's not a very well-grounded concern. And I'll try to explain to you why. A central bank has zero interest in using the personal data of the clients of the banks, because as François indicated, the banks will be the natural intermediaries that will actually be operating what is legally required in terms of anti-money laundering, countering the financing of terrorism, and know your customer regulatory requirements. The central bank is not going to do that. So the central bank is not interested in data. The central bank does not want to monetize data. On the other hand, some of the big tech companies that are considering venturing in the field of stable coins in particular have a great interest in collecting, handling, and analyzing data on a grand scale and monetizing it. So I think the anxiety is misplaced in relation to a central bank, and should be more concerned about what use is made of personal data and information by some of those large tech companies. Additional point, banks, commercial banks, of course have a lot of data. When we receive our reports, we know exactly how much we spent on food, how much we spent on traveling, how much we spent on entertainment, because our banks are telling us, essentially. So those data are available, analyzed, and are of service. It's a question of governance. How is it used? Is it monetized? Is it then, commercialized in some shape or form? But it is not in the interest and in the business of a central bank to actually do anything, mess around with data. Is it going to be as private as cash? No. So a digital currency will never be as anonymous and as protecting of privacy in many respects as cash, which is why cash will always be around. If people want to use cash in some countries or in some transactions, cash should be available. A digital currency is an alternative, is an other means of payment, and will not provide exactly the same level of privacy and anonymity as cash, but will be pretty close in terms of complete neutrality in relation to the data. Now, we are looking at what would be sort of under the baseline of what we're exploring at the moment. We're looking at options to make this digital currency that we call cash plus, almost cash, with really almost the same level of anonymity and privacy as cash. And this is work in progress, which I hope we will have developed further before next October. Can I make one more point?
Absolutely,
I just want to draw one distinction, because both Ravi and Xiangyang have spoken very, very eloquently and very intelligently about the programmability of a digital currency. I just want to draw the line between what I understand to be programmability of a digital currency issued by a central bank and alternative provisions. For us, the issuance of a digital currency that would be central bank money would not be programmable, would not be associated with any particular limitation, whether it's in time, in type of use. That to me would be a voucher. It wouldn't be digital currency. Those who can associate the use of digital currency with programmability would be the intermediaries, would be the commercial banks. And that's their business. They know how to do that. But if we are to say that a dollar is a dollar, whether it's cash or digital, or a euro is a euro, cash or digital, then for us, it cannot be programmable. It can be associated with conditionalities, which is different, but not programmable.
I think that's a very important point that we can explore, actually, Ravi. How do you see programmability in this context?
Yeah, so no, I agree with Christine that the retail CBDC that the central bank issues in and of itself will not be programmed, because the central bank has no interest in programming the money. But what I'm saying is that what does a central bank issued retail CBDC do that today cash and notes and coins can't do? And that's programmability, because when this cash gets transmitted through the system, it can't be programmed. But the retail CBDC that a central bank issues as it goes through the system, it can be programmed. Because you are expressing money in token form, the ownership rights are expressed in digital form, in form of a program. And so you can write into the program conditions for its use. Once that conditions are met and the money is discharged, it goes back to its original form. So it is basically the ability to write a computer software program on money to move it around for a specific purpose. And after that, it ceases, and then it can be written by others who use that money. So the way I look at programmability is that it is an option that can be built into digital currencies that make them useful. So we need to be clear in our minds, what is it that CBDCs do that currently cash can't do? And one is programmability, mostly I would think for domestic purposes. The other is atomic settlement for cross-border payments. Because today cross-border payments is not great shape. It's not in great shape. And I think collectively
What is atomic settlement, I want to know.
Atomic settlement is where you can exchange two assets in real time, and settlement is instantaneous.
It's bundling.
Right?
Bundling of transactions.
Bundling of transactions.
Okay.
And that's why I said cash, if I owe you 10 euros and I give you 10 euros, I've not only paid you, I've also settled. Whereas if I send it through the banking system, your bank and my bank has not settled. I've paid you, but the bank has not settled. This is a huge problem. It is inefficient, it is archaic actually in the modern age of the internet, that our banking system works like this, where settlement is not instantaneous. And you can imagine the cost. There's daylight settlement risk that all banks face. They have to put aside collateral in case settlement doesn't happen. The delay of 3 days or 2 days is an additional friction in the system. CBDCs can help to solve that. Because with CBDCs, it is equivalent to cash being exchanged, euros for dollars being exchanged instantaneously. And that can be done on multi-CBDC platforms. And the BIS Innovation Hub is doing great work in the Swiss Center, the Hong Kong Center, and the Singapore Center. And many others are doing the same thing. So the key is whether this can be scaled. So I think these are the two real killer apps, if you will, programmability and atomic settlement. One is cross-border, programmability is domestic, and that's not the central bank's role. We are just making that option available. That here, I used to give you paper money. Now I'm giving you in token form the same cash, but with this feature that you can build on. And I think governments will probably use it for purpose-bound money when they want to give money to lower income groups to buy daily essentials and necessities. That can be programmed. You can actually program payments along a supply chain. If you write a program, is basically a smart contract. And so today, again, like cross-border payments, our trade finance and trade logistics is hugely inefficient. Lots of documentation, lots of reconciliation, lots of duplication work, because nobody has a common ledger. A distributed ledger means everybody operates on a single ledger, and when conditions are met, documentation is filed, payment is automatic and seamless. So these are possibilities. It looks a little science fiction because there are huge problems you need to overcome to get to that stage. But many smart people, both in the public and private sectors, are working very feverishly. And as Francois said, the central banks are getting into this, because unless we dirty our hands, we're not going to understand the intricacies involved here. So I think these are the two. So programmability is not an absolute must, but it's one of the two killer apps, I think. There could be others. And this point has been made. When you make something like this, a technology available, there could be 3 or 4 other functions that come in. Just to close off, there is automated market making. Again, those experiments, we've been doing some of that, where if you can, today liquidity risk is a huge problem for all of us, and we're still facing it, right? And to look for a counterparty for liquidity. And with automated market making, you are actually trading against a pool. And this can potentially, and this has been piloted and is successful. The question is, can we scale it? And to scale it, you need a framework of trust, of who you can bring into the system. And you can, alongside solving the settlement risk problem, considerably address the liquidity risk problem. So their possibilities are boundless, and I think we need to continually innovate and experiment and learn from failure, because there have been many things that didn't work, and really evolve towards building a much better monetary system that's fit for the 21st century.
Very good. I think, actually, Christine, your emphasis on governance really is key, I think, for this discussion as well. And in a way, Ravi, I think many of the hurdles will be the design of the governance, not purely the technical issues. And And Chang-Yong, I think this brings me to a question for you, which is on the relevant stakeholders as central banks take the projects forward. Clearly, central banks are at different stages in their thinking and their development of these various projects. But just as governance is important in the design, and of course, I think with data in particular, already the financial system is already highly digitalized. It's just that we have a very well tested framework to preserve privacy, and the same type of design will need to be in place, even if it's a central bank that actually has the data as well. So maybe we could bring it to broaden the discussion a bit, to talk about the relevant stakeholders. Who are the relevant stakeholders that we should be thinking of as we embark and as we continue on this journey?
Do you mind if I give my comments on the Christian question first, and then move to the stakeholder issues? I think, Christian, to address that issue, single list of money, when the programmability allowed for the CBDC, we believe addressing having a wholesale CBDC, not programmable, but ask the tokenized deposit to take care of this job, is the best way. Mm-hmm. One problem is that what happens if the government, for example, Minister of Finance, want to have some kind of program in distributing their subsidies. So we're going to test whether that kind of function can be done with wholesale CBDC without programmability, but ask the private sector to do it. So if that can be done, I think this problem will be disappear. Yep. As for the stakeholders issue, I think in our last pilots, we find that the banks, big tech companies, regulators, and general public are important stakeholders. And probably I find that our Korean stakeholders are much more positive and demanding on this CBDC issue compared to other countries. That may reflect that the crypto trading and digitalization is well advanced. For example, Korea is the third largest country in Bitcoin trading, and more than 50% of local currency denominated crypto trading is done in Korean won, and more than 16% of the adult population has a regulated bank account for the crypto transactions, which is one of the headache to me. As such, the opinions are quite diverse, and some people believe crypto is a pure gimmick and it has to be completely banned. On the other hand, some people younger generation, believe that CBDC can be a good complementary technology in providing a right way to develop the crypto and other digital technologies. For instance, one young businessman suggested me to set up a digital Bank of Korea in the metaverse so that he can promote NFT transactions. So you can see that. And our bank are more aggressive, and they believe this issue is more existential threat and opportunity. So using CBDC, they want to penetrate and integrate their banking services to the existing platform, which is run by the big tech companies or the service providers. So that is why they actually very much interested in this tokenized deposit exercises. Our large manufacturing companies also interested in. Samsung Electronics, for example, has already blockchain wallet in their smartphones, and LG Electronics is planning to launch the NFT trading platform in their smart TV, so that NFT purchasers can see their NFT, TV screens. Tech companies are very much interested to join our payment service system, and they actually demand that equal access to the Bank of Korea's large value and the retail payment system. That is a very uncharted territory for us. We have to really test whether our new CBDC platform is suitable enough to protect zero risk principle of the payment system if the large tech companies are allowed to join. And the regulatory system needs to be more comprehensive, covering legal issues, competition issues, consumer protection and data protection, cross-border cooperation, on top of the traditional regulatory system. In some, there are many stakeholders, but their opinions are quite varied from to one end to the other. So how to communicate them when we introduce a CBDC is a challenging task.
Yeah.
Francois?
No, if I may add 2 sentences
Absolutely.
on the stakeholders. First, we shouldn't forget about merchants, and they will be very important for the success of retail CBDC. And second, about our fellow citizen and the broad public. We have probably a very strong political argument on our side, which is to maintain direct access of ordinary citizens to central bank money. In the past and still today, it was a banknote. It should be tomorrow a digital banknote. But probably our fellow citizens are not very aware of this argument. They are much more sensitive to additional services like the ones Ravi mentioned. So it's our job to explain that this political argument is very important for the future of money.
Absolutely, absolutely. So we've come to the end of our time. This has been a terrific discussion, and I will not even attempt to summarize it. But I think one thing that has really come out from this session is that we should think of CBDCs not as a standalone object, but very much in the context of the broader monetary system, and in particular in this broader context of the, if you like, the legitimacy of central bank money. It's the marker of the trust in central bank money that will clearly operate with private sector claims working seamlessly to preserve the core of the trust in the monetary system. And all these other very important features, such as the singleness of money. And Christina, I just like I really like your threefold goal: integrity, resilience, and integration. I think that's a terrific way to summarize these broader the broader governance benefits actually of CBDC in the broader context of the monetary system. Well, all good things come to an end, I'm afraid. So this has been a terrific panel. Thank you very much for all your contributions. And I gather we're going to take a break.